value all property to current market value at each year end. On 31st December, the value of South's property remained unchanged from its acquisition date value, but the land elements had increased in value. So what it means is the land element at acquisition date, there was no change, but by the date of acquisition, it has increased, and therefore we will add that also to the asset because it is not yet recorded. It is not yet recorded. If the subsidiary had recorded that already, then we wouldn't have to do any adjustment. We are doing the adjustment because we are told that subsidiary's land has increased in value. This is a post-acquisition increase. Post-acquisition increase. So it has to go into an increase in the land, the PPE, and the corresponding is revaluation. So it's an OCI item. And if you check, we have land revaluation reserve in the books of the parent. So put the parent share in that land revaluation reserve. This is land. It's been revalued. The increase, this is not at acquisition. This is post acquisition. What would have happened at acquisition is different. You need to have a clarity of these things. We are at post acquisition. This land has been revalued per IAS 16. When you revalue land, the increase is to OCI revenue, and therefore you will not recognize this in the retained earning. You will recognize this in the land reserve, revaluation reserve in the statement of financial position, right? Then the next item, which is to help you remember that an entity, a parent, can acquire shares in another entity, and it gives rise to 4 different relationships. One that is control, one that is significant influence, one that is joint control, and one that is none of the 3 I have mentioned. And the one that is none of the 3 mentioned, we account for using IFRS 9, which we have already done. So I'm only bringing IFRS 9 into consolidation for you to see how it works. Another day, you will see IAS 28 in the consolidation. Another day, you will see IFRS 11, the joint control in consolidation. This is the way I want you to think about the parent accounting for its investments in subsidiary, in associate, in joint venture, in joint operation, in simple trade investment. So this one is about simple trade investment. Parent investments include equity which were classified as fair value through profit or loss. No, fair value through other comprehensive income. So this is equity through other comprehensive income. So you recognize the fair value. If there is any transaction cost, it has to be part of the fair value. By here, you are told that this transaction has already been recorded. So we are only recording the increase in the value of 300, which should be recognized in OCI. So you recognize it in other components. You cannot recognize it in profit or loss because it's fair value through other comprehensive income. It's not profit or loss. It's not retained earning. So you recognize it in OCI because it is classified as fair value through other component comprehensive income. So you take it to equity, and therefore you will recognize it in other components of equity, right? The dividend will be recognized through profit or loss. And this is IFRS 9, guys. This is IFRS 9. So it's it's to help you remember that. And then the last point, of course, parents parent limited policies to value non-controlling interest at fair value for the purpose sub-limited share price at that day can be deemed to be representative of the fair value of the shares held by non-controlling interest. And so the 20% or so of NCI, 20% of the 5,000, which is for NCI, times the price of NCI shares, which is 3.5, will become the fair value of NCI, which will be used in the computation. The last but not the least, it was determined at the year end that 10% of the goodwill relating to the acquisition of SAP was impaired. The goodwill was impaired, and so you have to calculate impairment. And because the goodwill NCI is at fair value, goodwill will be calculated using fair value, and therefore this impairment will have to be borne or be shared between parent and NCI. Now, the most interesting part of this question is how to determine your retained earning at the date of acquisition. Your retained earning at the date of acquisition. And I'm sure you've been taken through that, so I'm not going. It's a mid-year acquisition, and it was acquired 1st September. So what it means is they made a profit for the year of 6.8, and the question says it. You should assume that it accrues evenly, which means every month you can share this profit as being earned equally every month. That's what accrue evenly means. So the 6.8 million was earned monthly. So you divide by 12. You divide by 12. Now the first 8 months is pre-acquisition profit, and the last 4 months is post-acquisition. So if you want to know your retained earning at the date of acquisition, take your retained earning at the beginning of the year. Take your retained earning at the beginning of the year and add your profit, your pre-acquisition profit, and it will give you the retained earning at the date of acquisition. Beginning of the year is 1st January 2021 because the reporting date is 31st December 2021. The beginning of the accounting year is 1st January 2021, or it's 1st January 2021. So take the retained earning at 1st January 2021 and add 8 months of profit to it. Then you will get your retained earning on the date of acquisition, which is 1st September 2021. Or take the retained earning at the end of the year, which is how much? Retained earning at the end of the year for the subsidiary is 9,500 or 9,500,000. That is at the end of the year. This is the opening retained earning plus the profit for the year. So if you want the retained earning at the date of acquisition, take 4 months out of the 9.5 million. Take 4 months out. The 4 months in this 9 is post acquisition. So take it out and you have your profit, your retained earning at the date of acquisition. And that is the implication of a mid-year acquisition. Mid-year acquisition. And I'm giving you this to begin to see the difference between a question where the subsidiary was acquired like at the beginning of the year, and where a subsidiary is acquired mid-year and how it differs. Now, try your hand on it. You are having tutorials on this, so follow the tutorial discussions. The TAs and the SRAs are there helping you take advantage of it. This video is to help you understand what they are taking you through. So go ahead, attend tutorials and get the solution right. Any question, post on the classroom page. Thank you.